Something extraordinary just happened in the silver market, and Wall Street doesn't want you to see the full picture. Today is December 24th, 2025, and silver is trading at a staggering $72.41 per ounce, a fresh all-time high. But here's what should make every investor sit up and pay attention. The whispers coming out of major financial institutions aren't about whether silver will keep climbing. They're about how high it can go before the system breaks. Let me walk you through what is really happening behind closed doors at the world's biggest banks, and why some analysts are now openly saying $100 silver is not a question of if, but when. The October revelation that changed everything. Back in mid-October 2025, Bank of America did something unusual. They released updated forecasts for precious metals that sent shockwaves through trading desks worldwide. The official line? Gold to $5,000 per ounce, silver to $65 with an average of $56.25 for 2026. But here's where it gets interesting. That $65 target was already conservative by the time the ink dried. Remember, when Bank of America published that forecast on October 14th, silver was trading around $37 to $39 per ounce. A call for $65 represented a roughly 67% gain. Ambitious, sure, but not crazy given the fundamentals. Fast forward to today, December 24th. Silver has already blown past that target, touching $72.70 earlier in the session. Bank of America's bullish forecast is now in the rearview mirror, and we still have all of 2026 ahead of us. So what happened? Did the banks get it wrong, or did they know something they couldn't say publicly? The $100 Whisper Network. Here's where the story takes a turn. While Bank of America's official forecast topped out at $65, a different narrative was circulating among institutional strategists who actually understand the physical market dynamics. Felipe Geisels from BNP Paribas broke ranks in October. He didn't hedge, didn't qualify, didn't use the usual banking language of could potentially reach if conditions align. He said silver could hit $100 per ounce by the end of 2026, period. Then, Larry Lepard of Equity Management Associates weighed in at the New Orleans Investment Conference in November. Lepard manages a fund focused on precious metals, which means his livelihood depends on getting this right. His forecast? $75 by mid-2026, $80 to $90 by year-end. And in multiple interviews, he's made clear he believes $100 is easily achievable given the structural deficit. These aren't fringe voices. BNP Paribas is one of Europe's largest banks. Lepard has been accurately calling precious metals moves for years, and they're not alone. Keith Neumeyer, CEO of First Majestic Silver, has been pounding the table on triple-digit silver for nearly a decade. His latest call? $100 to $130 per ounce. And he's been remarkably consistent about it, even when silver was languishing at $17. The numbers banks can't ignore. Let me show you why the conservative forecasts are already obsolete. Silver has gained 148% year-to-date as of this morning. 148%. That's not a commodity exhibiting normal price discovery. That's a market screaming about fundamental scarcity. The London Bullion Market Association vaults, which serve as the global hub for over-the-counter precious metals trading, are operating on fumes. Available stockpiles have collapsed from over 300 million ounces just a few years ago to approximately 125 to 135 million ounces today. Think about what that means. Daily trading volume in silver averages 250 million ounces. There's less than 1 day's worth of actual physical silver backing all the paper promises in the market. It's exactly like running a fractional reserve bank, where the fraction has gotten dangerously small. Daniel Gali at TD Securities calculated in October that London's free-floating stockpile could be completely depleted in less than 4 months at the current rate of drain. 4 months. We're now 2.5 months past that warning, and the drain has only intensified. The India factor. No one saw coming, remember? October 2025? That was when three things collided to create the perfect storm that's still raging today. India went on an unprecedented silver buying spree. Imports doubled in September compared to the previous month, driven initially by Diwali festival demand. But here's what shocked the market. Indian buyers didn't stop after Diwali. They kept buying and buying. Even as prices rocketed to record highs in rupee terms, demand stayed strong. When Hong Kong couldn't supply enough metal to satisfy Indian appetite, buyers pivoted to London. And when JP Morgan Chase, the world's largest precious metals trader, told major Indian clients in October they had zero silver available to ship, that's when people realized this wasn't a temporary squeeze. This was a structural shift. Several Indian exchange-traded funds had to stop accepting new money because they literally couldn't source the physical silver they needed to back their shares. Yet other funds kept accepting orders, raising serious questions about whether they could actually deliver. Phil Baker, a veteran silver market analyst, calls India the marginal buyer, driving prices above $45 to $50. Indian demand hasn't just grown, it's quadrupled. And unlike speculative Western buyers who sell into strength, Indian buyers are protecting themselves against currency debasement. They're not trading, they're accumulating. The industrial demand time bomb ticking louder. We haven't even addressed the elephant in the room. Industrial demand is accelerating, not decelerating. Solar panel installations are exploding worldwide. Every solar panel requires silver for its photovoltaic cells, and the Silver Institute estimates the solar sector alone consumes over 230 million ounces annually. That number is projected to keep climbing as countries race toward renewable energy targets. Electric vehicle production is ramping up, and EVs use 25 to 50 grams of silver per vehicle, significantly more than traditional cars. Data centers powering artificial intelligence are proliferating at breakneck speed. Each one demands silver for circuit boards and electrical connections. The AI energy complex represents a massive new source of demand that barely existed 5 years ago. And here's the kicker. These industrial users can't take the risk of production shutdowns. They're building 6 to 9 months of inventory buffers, which means they're pulling metal off the market and hoarding it. Recycling can't keep pace. You can't thrift your way out of this shortage. The market has operated in a structural deficit for 5 consecutive years. The cumulative shortfall over the past 4 years has reached 678 million ounces, the equivalent of 10 months of global mining supply. Why banks say 65, but mean 100? Let me explain something about how institutional forecasts work. When a major bank publishes a price target, they're not trying to predict the actual high. They're providing a number their corporate clients can use for planning and risk management. Banks can't afford to be wildly bullish publicly because their corporate clients, the miners, the industrial users, the hedgers, need stable, credible forecasts to make business decisions. If Bank of America came out and said silver's going to $100, they'd create panic among their hedging clients and potentially destabilize contracts they've already written. But here's what you need to understand. The same analysts writing those $65 forecasts are seeing the same data everyone else sees. They know about the London Vault depletion. They know about the Indian demand surge. They know industrial demand is outstripping supply. So what do? They publish conservative official targets while quietly telling their biggest clients to prepare for much higher prices. That's not conspiracy theory. That's how institutional sales and trading works. The official forecast is for public consumption. The real guidance happens in private conversations. Look at what happened with their October forecast. Bank of America called for $65 in 2026. We hit that level in December of 2025, more than a year early. Either their analysts are spectacularly incompetent, or they were being deliberately conservative because they knew the official target would be exceeded quickly. The technical setup, pointing to 3 digits. Now let's talk about what the price action is telling us. Silver broke out above the multi-decade resistance at $50 per ounce back in October. That wasn't just a psychological level. It was a technical fortress that had held for over a decade. Once that barrier shattered, it opened up clear air to much higher prices. The gold to silver ratio has compressed from over 80 at the start of 2025 to around 62 to 64 today. Many technical analysts believe this ratio is headed toward 50 to 60 in the coming year. If gold holds around $4,400 to $4,500 and the ratio compresses to 55, simple math puts silver at $80. If gold pushes toward $5,000, Bank of America's official target, and the ratio compresses to 50, we're looking at $100 silver. That's not hopium, that's historical pattern recognition. Silver tends to outperform gold in the late stages of precious metals bull markets. We saw it in the 1970s, we saw it from 2008 to 2011, and we're seeing it again now. The monetary policy tailwind getting stronger. The Federal Reserve just completed 3 consecutive interest rate cuts in 2025, and traders are betting on 2 more cuts in 2026. Lower interest rates make non-yielding assets like silver more attractive because the opportunity cost of holding them decreases. The US dollar has softened in recent weeks, making dollar-denominated commodities cheaper for international buyers. That mechanically increases demand from overseas buyers who are suddenly getting more purchasing power. But here's the deeper issue that banks like BNP Paribas and analysts like Leopard are focused on. We're entering what could be a sovereign debt crisis. The fiscal deficits are enormous, the debt levels are unprecedented, and central banks worldwide are losing credibility. When faith in fiat currencies erodes, real assets perform. Gold and silver are not just industrial commodities. They are monetary metals with 4,000 years of history as stores of value. In an era of currency debasement and trillion-dollar deficits, that matters more than most people realize. The supply response that isn't coming. You might be thinking, surely high prices will bring more supply to market, right? That's economics 101. Except it doesn't work that way with silver. Approximately 70% of silver is produced as a byproduct of mining other metals: copper, lead, zinc. Primary silver mines account for less than 30% of global supply. That means silver production responds more to the economics of base metals than to silver prices themselves. Even with silver at $72, if copper prices are weak, miners aren't going to dramatically increase production of copper mines just to get the byproduct silver. Mine supply has remained essentially flat at around 813 million ounces annually for years. Ore grades are declining. Exploration hasn't been adequately funded. The supply response to higher prices will be measured in years, not months. Meanwhile, demand continues to surge. The math is simple and brutal. The deficit isn't closing anytime soon. Why $100 is conservative? Let me put this in perspective. Silver at $72 today is trading at roughly 1/6200th the price of gold on a ratio basis. If we adjust for the historical production ratio, about 9 ounces of silver mined for every 1 ounce of gold, silver should theoretically be trading around $445 when gold is at $4,000. Now, I'm not saying we're going to $400 silver tomorrow. Markets don't work based on should or historical ratios. But it illustrates just how far silver could move and still be within historical norms relative to gold. The 1980 high for silver, adjusted for official inflation figures, comes in around $150 in today's money. Some analysts who use broader measures of monetary inflation put the inflation-adjusted high closer to $1,400. Even if we completely ignore those extreme scenarios, getting from $72 to $100 represents less than a 40% gain. After a 148% move year to date, does a 40% continuation move seem impossible? Or does it seem like exactly what you'd expect in a market characterized by structural deficits, exploding industrial demand, and vault stockpiles that could be depleted in months? The early 2026 setup. As we head into 2026, several factors are aligning that suggest the next leg higher is imminent. Exchange-traded fund inflows have been extraordinary. Bank of America highlighted that ETF inflows surged 880% year-on-year in September, reaching a record $14 billion. Those flows have moderated somewhat, but they haven't reversed. Investor appetite for precious metals exposure remains robust. Geopolitical tensions are running hot. The U.S. blockade of Venezuelan oil, escalating trade policy uncertainty under the Trump administration, ongoing conflicts in Ukraine and the Middle East, all of these factors support safe haven demand for precious metals. Fed independence concerns are emerging as a new driver. President Trump's threats to remove Fed Chair Jerome Powell and the recent dismissal of Governor Lisa Cook have raised questions about the central bank's credibility. If confidence in the Fed erodes, the dollar's reserve currency status faces increasing pressure. That's massively bullish for alternative stores of value. What the smart money is doing right now. While Bank of America's official forecast says $65, their actual positioning tells a different story. Major institutions are building long positions in both physical silver and silver mining equities. Larry Lepard spelled it out clearly. Mining costs for many silver producers run between $20 to $30 per ounce. If silver goes to $120, and he thinks it will, that's profit margins miners haven't seen in over a decade. Silver mining stocks could triple or quadruple from current levels if physical silver reaches triple digits. This is why insiders at funds like Equity Management Associates, at mining companies like First Majestic, and at boutique research firms are so bullish. They're not looking at Bank of America's public forecast. They're looking at vault inventories, production costs, industrial demand, monetary policy, and fiscal deficits. And all of those indicators are flashing bright green for silver. Let me paint you a picture of how this plays out over the next 12 months. We're already at $72 in late December 2025. The typical seasonal pattern sees precious metal strength in the first quarter of the year as Asian buyers return after holiday selling, ETF rebalancing flows kick in, and new investment money enters the market in January. If silver follows anything close to its historical pattern, we could see $80 to $85 by March or April. That would put us right in line with Lepard's $75 by mid-year forecast. In fact, we'd be ahead of it. From there, the question is whether industrial buyers panic. If data centers, solar manufacturers, and EV producers start hoarding inventory because they're genuinely worried about supply availability, we could see the kind of buying surge that pushes prices well into the 90s in the second half of the year. At that point, $100 becomes inevitable. It's not the ceiling, it's just the next psychological level that gets tested and broken. Why this time really is different. I know what you're thinking. Every bull market produces calls for absurd price targets. Every squeeze generates claims that this time is different. And usually it isn't. But here's what's genuinely different about the current silver market. The fundamentals have never been this extreme. We've never had 5 consecutive years of structural deficits. We've never had vault stockpiles this low relative to trading volume. We've never had the combination of industrial demand from green technology and AI infrastructure hitting at the same time as safe haven investment demand from monetary policy concerns. The last time silver had a run like this was 2008 to 2011, when it went from roughly $9 to $49, but that move was driven primarily by investment demand. Today's move has industrial demand as the base case, with investment demand and monetary concerns layering on top. And here's the crucial difference. In 2011, there was no structural supply deficit. Supply could respond to higher prices. Today, supply is constrained for structural reasons that won't change quickly. The bottom line Bank of America's official $65 forecast for 2026 isn't wrong. It's just incomplete. It's the floor, not the ceiling. It's what happens if nothing goes wrong, if industrial demand doesn't accelerate further, if vault depletion doesn't reach critical levels, if Fed policy doesn't get more dovish, if fiscal deficits don't spiral further out of control. But when do markets ever follow the calm, steady, nothing goes wrong scenario? The analysts saying $100 silver, Leopard, Geisels, Neumeier, and a growing chorus of others aren't making wild speculative bets. They're extrapolating what happens when you have structural supply deficits, exploding industrial demand, depleting physical inventories, and a monetary policy environment that's increasingly favorable to hard assets. Today, December 24th, 2025, silver closed at $72.41. We have already exceeded what Bank of America thought would be the high for all of 2026. And we're not even into the new year yet. If you think the story ends here, you haven't been paying attention to what's happening in the physical market. The vaults are draining. Industrial demand is accelerating. Central banks are trapped by debt levels that make aggressive rate hikes impossible. $100 silver in 2026 isn't a moonshot prediction. It's the logical conclusion of trends already in motion. Trends that banks like BNP Paribas are finally acknowledging publicly, and that Bank of America is acknowledging privately to their biggest clients. The only question left is whether we hit $100 by mid-year or year-end, and whether the move stops there, or if we're just getting started on a repricing that takes silver back toward its inflation-adjusted highs. The Whisper Network on Wall Street already knows the answer. Now you do too.